What if you could spot the next big AI bubble before it bursts? Today, we're diving deep into the lesson from the dot-com crash and why smart money is already playing a different game. All right, imagine this. It's 1999. A sock puppet, yep, a goofy sock puppet, hits the Nasdaq opening bell. The crowd? They're going nuts, cheering, screaming like it's a rock concert. And why all the hype? Because of a website that ships heavy bags of pet food, 50 pounds each, for free. Yes, for free. And here's the kicker. They lose money on every sale. Why would anyone fund that? Back then, the name of the game was eyeballs. How many people visited your site? Not whether it was profitable or made sense. It was about traffic. Fast forward to today. An AI startup that's yet to make a profit just closed $1 billion funding round. $1 billion. And their big achievement? They made a haiku about someone's dog. Ah, haiku. Different century, different buzzwords. But that feeling? That missing out on something huge, gut instinct? Exactly the same. Now let me tell you what happened to those who bought into the last hype. If you bought Pets.com stock at the peak, at the absolute top, you didn't just lose money. You lost 98 cents of every dollar you invested. 98 cents. Gone. Here's the worry. If you're jumping into these new AI companies without understanding how they'll actually pay for those massive GPU farms, you could beat that record. And do it in half the time. Look, company names change. Buzzwords change. In 1999, it was eyeballs. Today, it's neural networks and large language models. Tomorrow? Who knows? Quantum consciousness? Maybe. But your human brain? That's the same. Pattern recognition. Fear of missing out. Herd mentality hardwired since the days we hunted on the African savanna. Wall Street? They know exactly how to push those buttons. So let's rewind. Spot the patterns. And most importantly, protect your portfolio. Not just survive, but thrive. Let me tell you about Boo.com. You probably don't remember it, unless you're a hardcore internet history buff. This company? It burned through $135 million in just 18 months. That's like tossing million-dollar bills off a roof, 18 times a month, for a year and a half. What did they sell? Fashion. Nothing revolutionary. How? With this elaborate 3D avatar. Imagine dial-up internet that loads at the speed of continental drift and waiting 2 minutes just to load a single page. Did investors care? Nope. They bought into get big, fast, the mantra, the full philosophy. And Cisco? 80 times its revenue. That's like paying $80 for a dollar. Then, the Fed raised rates. The IPO window shut. The Nasdaq? It plummeted 78%. And the lessons? Almost no one learned. They just kept chasing the next hype, only to get hammered again. Fast forward to 2024, a survey. 61% of retail investors bought AI stocks because they saw a tweet. Not because they analyzed the company or understood the tech, but just a tweet. FOMO. Fear of missing out. Driving the rush. And the language? It sounds high-tech. Training runs, neural networks, foundation models. But beneath it, it's the same urge. Your brain craves that dopamine, that thrill of possibility. And the stakes? Much higher. Just 10 companies, less than 2% of the S&P, make up 63% of this year's gains. 7 of those are wrapped in the AI hype. Imagine being at a full concert. Everyone rushes to one exit. If sentiment shifts, it'll be a chaotic scramble. And those who aren't paying attention? They'll get trampled. Let's talk about valuation. OpenAI? Valued the same as General Motors, despite vastly different revenues. GM builds millions of cars. OpenAI's revenue? Smaller than many grocery chains. And Palantir? It's trading at 25 times sales, with 92% of revenue from just 20 customers. It's like making bread for one street. If they shut down, your entire business vanishes. Back in 2000, Cisco looked unstoppable. Then the Fed raised rates. Market valuations? They crashed. Hope isn't a strategy. Numbers, cash flow, customer diversity, that's what matters. When interest rates rise, future profits get heavy, and valuations collapse. This time, things are a bit different, but not entirely. Back then, starting a .com was cheap. One server, some ads. Today, It's costly, massive GPU farms, cooling, infrastructure. That barrier weeds out the wannabes. And VCs? They're scrutinizing more, demanding real revenue, real customers, real economics. And AI? It's already making money. Last year, AI-related sales hit $110 billion, more than 13 times what they were in 2014. It's not just hype, it's transforming industries, manufacturing, healthcare, logistics. Already deploying AI for real gains, more stability, less risk of overnight vaporization. So how do you participate safely? Build a firewall set rules before you invest. First, write down exactly where the cash is coming from. If you can't answer that clearly, don't invest. It's speculation. Second, limit your exposure, no more than 5% of your portfolio per AI stock. This way, if they crash, you're still okay. Third, look beyond the hype. Find companies using AI to boost what they already do. Industrial, healthcare, logistics, profitable businesses. Fourth, use dollar-cost averaging. Buy some now, more later, some when it dips, to smooth your entry. Fifth, set a kill switch. If the investment drops 40%, pause and reassess. That's how you stay in control, even when emotions run high. The dot-com bust was catastrophic. Wealth gone, dreams crushed. But the infrastructure? It kept growing, improving, evolving. Fiber optics, data centers, still powering our streaming media and communications. And AI? The core tech chips, algorithms, will keep advancing. Even if today's stars fade, the trend persists. Think like a prospector. Instead of betting on one big nugget, sell the shovels. Chips, infrastructure, utilities. That's the safest, most steady way to profit from this long-term trend. Let's cut the hype. No profits, no real customers, just hype? Walk away. CEO cares only about stock price? Walk away. Growing revenue by issuing new shares? That's fake growth. Walk away. Saying profit after AGI? That's bedtime storytelling, not a plan. Stay cautious. The Fed is always the DJ, turns down the music when it's time. When interest rates go up, valuations slip. Fast. Story stocks, those with no earnings, fall hardest. Unemployment rising? AI CapEx. Freeze. IPOs? Postponed. Private deals? If they stall, it's a signal. Those smart investors? They're already out. By then, it's too late. Stay alert. Stay cautious. History rhymes. It doesn't repeat. Hype without a cash flow? It's like a marshmallow fortress, sweet and fluffy and destined to melt. But the underlying AI tech? It's real, it's powerful, and it's here to stay. Play smart. Buy the foundations, the companies with real earnings. Diversify wisely. Set your rules. Keep that exit door open. Follow these guidelines, and when the next hype cycle crashes down, you'll still be standing. Build something that lasts. That's the goal. If you found this helpful, hit like, subscribe for more deep dives on stocks and AI, and leave a comment with your thoughts or questions. Let's talk. Thanks for watching, and see you in the next video.